Welcome to Trading Nation. I'm Courtney Reagan. I'm joined today by Joseph Mezrich. He's head of equity quantitative strategy for Instinet. Joseph, thank you so much for joining us. You say that active management is about to stage a big comeback, and it probably needs one. It has not been doing so great. Can you tell us why you have this theory?
Well, it's based on the data. I mean, we've done something kind of unusual. We actually looked at the history of the experience of active managers. We used a pretty good database put up at the University of Chicago. It's kind of the gold standard of this topic. It goes back half a century. And the simple story is if you look at the experience of active managers, and we looked at the 5-year rolling returns of all managers, all mutual funds rather, in the United States. And if you go back that far, this has happened before. I mean, this is the 4th episode in half a century where active managers have spiraled down in performance. It's been going up by 7 years now. And just to give you some numbers, only about 6% of active managers of funds have outperformed benchmarks after fees in a 5-year history, which is pretty awful. But to give you some perspective, in '98, only 3% did that, and there was an experience like that in '87 and in '76. So we've been here before, and each time it's happened, it comes back. So this is the we can get into details, but basically it's a mean reversion. Called mean reversion process.
And so did the data that you're talking about predict what we've just seen as well? I mean, is this reliable data to sort of show us exactly what happened so that we can count on what it says for us going forward?
Well, you mean you've seen before, I mean this year being not a good year for active managers.
Right, exactly.
Right, so it's a slow process. I mean, the way it works, let me take kind of the backdrop for this whole topic. So what we did is, ask why does a mean revert? Why does it, I use that phrase, but why does it go up and down, I guess, over time is the question. And it has a lot to do with the direction of interest rates. So give you a feel for the topic. If you go to the end of 1981, when the 10-year bond was at 60%, 93% of managers outperformed. It's like really amazing, right? And so rates were going up in the late 70s, and as they go down, managers underperform. And so what's happened this year is rates are bottoming. They're not there yet, and it's a long process. So I didn't predict the bad year of 2016, which it was, although not every quarter was bad. But the expectation is that over the next year, it probably, it'll take a while. We've hit bottom, and it may bottom here for a while, but the anxiety that managers have is that it's game over is not correct. This has been here before, and it's going to come back as rates come back up.
So if rates come back up and active performance improves, do you think that that will be enough to drive the money out of passive vehicles into active management?
That's a very correct question. I think the answer to that is yes. I mean, what's different about this cycle that wasn't true in other cycles are all the passive vehicles available. I mean, the ETFs, and that's kind of a new topic. And because of that, and because of the flows into that, the media has paid a lot of attention to that. But basically, I think that follows performance. I mean, if managers start doing well, then the money will come back to them. I think it's really what does well after fees will be rewarded with flows is the expectation.
And so quickly before we go, what are your expectations then for interest rates in order for this theory to go through? I mean, how high do they have to go?
Well, I mean, it has to be meaningful and it has to be sustained. So it's not enough if it goes up, 3%. Now we're talking about, it's been going down for 30 years basically, but let's say over the last 7 years or so, it's been dropping fits and starts. So it has to go up meaningfully. So don't expect, first quarter this year to be a big deal. I mean, I think that the point I would take from this is that throwing in the towel in active management because there's no hope for it is wrong. Will it turn around the quarter? That's probably too soon. But over the next year, certainly going forward, we're going to see a renaissance, is the way I would put it, because of the bottoming process.
I know there's a lot of people out there that are at least hoping for that renaissance, so we'll see if it does indeed come to fruition. I really appreciate you joining us and for your perspective. So my thanks to you, Joseph Mezrich of Instinet. Thank you all for joining us here on Trading Nation. I'm Courtney Reagan.
Thank you.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.